Hi, welcome back. All right, so what to do when markets gyrate? Scary thing when we see the market going through kind of what looks like a roller coaster where they hang you upside down and they've got you strapped in. Well, there are some things to know and be prepared for. I guess the things to understand about how the market operates so that when it happens, you're prepared. And so the first thing to understand is there are some inherent aspects to the market that really are always there. And so here are some of them, and I'll give you some tips on maybe how to prepare yourself for when the market goes through what is a normal correction or pullback. So that's really the first thing to know, is that market corrections, pullbacks, bear markets, these things are not unusual. Pullback, remember, is a 5% drop from a previous high. A correction is a 10% reduction from a previous high, and of course the bear is 20. So 5, 10, 20. So a 20% drop from a previous market high. If the Dow is at 18,000 points and it falls 3,600 points, that would be considered a bear market. Okay, so what is notable or exceptional, or what is a big deal here about these events? Well, the big deal is that they're actually normal and they're frequent. It's easy to forget when the market's doing well that we've had, ready for this statistic? This is amazing to me. Since 1950, the last 65 years through the end of 2015, every other calendar year, so half of the calendar years, it's not every other one exactly, but at least half of them have within that year a 10% pullback, a correction. So the fact that we experience a 10% fallback, pull down, any of those terms, the way people sometimes describe it in the media, of course they like to use even more exaggerated terms of, you know, the world's falling apart because the market fell 10% from a previous high. They didn't talk about how incredible, they don't use the same exaggerations when they talk about it going up. They talk, of course, that way when it's going down because bad news sells. So keep that in mind. But what's exceptional is, or rare, isn't the correction, it is a long, sustained bull market. Those are what are rare. So if we have 5, 6, 7, 8 years without a 10% correction, that is what is really unusual. All right, so that's number one, just to bear in mind as these markets gyrate, which they will and they do. Next is that stock markets are inherently unpredictable. It's very difficult to say what the market's going to do the next 6 months, the next 3 months, the next 2 days. It's kind of funny. Sometimes to me, the market seems to act almost with a vengeance. Let's say you've been watching the market and you're like, okay, that's it. I got to get out. And the day you get out, the very next day it goes up 5%. And you go, how can my luck be that bad? And it's like, well, golly, the market hates me. I mean, we get those feelings. And the reality is that it's difficult to predict, and there is a lot of randomness and, you know, difficult to ascribe behavior. I'll put it that way. And a lot of times you'll have a market that through the course of a day, it wanders all over the place. It's up 50 points or up 200 points. It's down 200, down. And then by the end of the day, it's down, say, 40 points. Well, 40 points on the Dow, where the Dow is today, is nothing. And then the media, because they've got to fill time, right? They have to fill time and they have to have an answer. They will find something in the news to say, Dow slid today because of there was a little melting in the polar ice caps. Or we don't know. I mean, that's the truth. So it's just it just works out that way. So, but the unpredictable part, you know, it should be no surprise that things like commodities are going to fluctuate based on supply and demand. A wonderful, relevant example is oil, okay? Oil prices have fallen significantly. We saw oil prices at $150 a barrel right at the beginning before we really had our nasty recession, the Great Recession back in 2008. And gas was at what, $5 a gallon? So there have been times we paid a lot for oil, and then of course there's times we pay a lot less. Recent oil prices, at the time I'm doing this program, are in the $30 a barrel range. do the math. That's 20% of the cost of what it was back in 2007, 2008. Wow. So there's a lot of fluctuation potential. So now, of course, those falling oil prices are wonderful for the consumer because it does translate to a lower gas price. But it also affects oil stocks and energy stocks. And of course, that affects people's wallets in another way. And the economic benefit that is felt by consumers takes a while to work its way through the economy. You know, $1.70 or $1.50 for a gallon of gas has an incredible economic benefit on our country. But on the other hand, falling oil prices have hurt stocks. So that is immediate, and we see it right away. So it takes a while for that benefit to work its way through. But the point is to be mindful of these things. And when you look at these things that are uncertain, when you look at things that can go up and down in value, the real lesson there is not to go all in on any one thing. You don't want to put yourself in that position. And you say, well, hey, look, oil is at 30 bucks a barrel. Good Lord, it could go up to 150. I'm just going to go in all in on that. Well, a $30 barrel of oil could go to 15 before it goes to 150. So be real careful going all in. And, you know, back to the nature of the markets real quick also on the behavior of the corrections. The other point is don't put all your money in the market, the money you might need for income. And then the third thing I want to get to here is the risk of loss is inherent. It's part of, to use a little bit of a cliche that I hear today in marketing and in different circles, it's in our DNA. That's one of the latest buzzwords. Well, you know, the truck, it's in its DNA to be rugged and strong. Okay, we get it. Okay. You want us to know that it's inherent as part of what makes up this product or vehicle, whatever it is. Well, in the DNA of the stock market is an inherent risk of loss. And I've got a great analogy for you that I'm very proud of. I really like this. The stock market is no lady. There's a short story of The Lady and the Tiger, and if you haven't ever read that, go find it. But the stock market is no lady. It's a tiger. Now, if you are feeding that tiger through a cage with your big hunks of meat, it's going to purr and love you and lick your hand if you let it and just smile at you and just be wonderful. But if that tiger is ever uncaged, like a 47% drop from 2000 to 2002 in the market, yeah, it wasn't that long ago, okay? 15 years ago, we had a 3-year downturn of 47%. That's like the stock market uncaged. That's like the tiger getting out. And maybe it's not so nice. Maybe you are its prey if it escapes. So the real question there is, could you stomach a 3-year drop? Could you afford to only get 50 cents back on the dollar? So the lesson, the tip, is don't invest money in the market that you're going to need for income or that you're going to need to draw out as a lump sum within a short period of time. You need to let that money work and work for you. And I'm a big fan, of course, of planning this all out so you know where you're going to get your income and not be forced to take money when the market's down, doing what it normally does, a correction. All right? Do those things, and you know what I'm going to say. That'll help you plan stronger.